My name is Mike DiCristofaro. I'm the Director of Advisor Relations at the Charitable Foundation. In this role, I focus my time on serving as a resource to advisors like you, helping your clients to plan, structure, and fulfill their charitable goals. Sometimes that means I get to talk about amazing nonprofits in New Hampshire. Sometimes I get to dig in with individual donors and their families to hear what motivates them and what's important to them. And sometimes it means I get to talk about tax law. As we know, the Tax Cuts and Jobs Act, which was passed in 2017, included a number of provisions that are set to expire at the end of 2025, unless other legislation is passed to intervene. A handful of ways I've heard this described are Taxmageddon, the Super Bowl of tax, the tax sunset, and Taxapalooza. We'll use sunset for most of our presentation. In our presentation today, we'll seek to highlight some of the changes that are written into the law and provide some useful ways charitable giving can be an effective planning tool to help your clients make tax-smart donations and maximize their impact. I'm fortunate to be joined today by Jen Rivett, a shareholder and estate attorney at Devine Millimet, and Peter Lee, the Director of Tax Planning at the Harbor Group. Jen will provide an overview of the major changes expected to the estate tax threshold and provide some ideas on charitable planning techniques that may help clients whose estates are near or above the new threshold. Peter will give an overview of changes expected to the standard deduction and individual tax rates and strategies clients can use to make their giving in the most tax-efficient manner. As a brief introduction to New Hampshire Charitable Foundation, I thought it'd be helpful to share our overarching purpose. NHCF is New Hampshire's statewide community foundation. Our purpose is to make New Hampshire a more just, sustainable, and vibrant community where everyone can thrive. We achieve that purpose by supporting nonprofit organizations with grants, providing scholarships to students, connecting generous people with pressing community needs and effective ways to give, and investing our charitable assets in alignment with our purpose and mission. As we seek to connect generous individuals, families, and companies to pressing needs, we approach our work in a number of ways, providing customized and flexible charitable strategies that fit each donor situation. I like to say we help your clients do the most with their charitable giving, finding causes that are most meaningful to the donor and their families, making the most impact on organizations they care about, and doing it in the most tax-efficient manner. Partnerships with professional advisors, such as yourselves, are a key part of how we connect with these generous donors looking to make the most of their giving. And that is why we work to provide you with the knowledge and tools necessary to discuss philanthropy with your clients. With that, I'll turn it over to Jen Rivett to begin and dive into the sunset of the Tax Cuts and Jobs Act.
Thank you, Michael. It's nice to see everyone or understand who's on the call. So I am just going to talk a very high level about some of the expected changes in the gift and estate tax laws. And also, again, as Michael had mentioned, just some planning tools to consider, again, very high level, but just to plant some seeds with you when you're working with your clients to consider some options that are available. So with respect to the change in the law, as Michael explained, we have a lifetime exemption from federal gift and estate taxes. So every taxpayer has the same exemption. We also have an exemption of the same amount from what's known as the generation skipping transfer tax. We're not even going to touch that because that's a full day discussion. But in general, in 2017, I'll call it the TCJA to shorten things. So the TCJA was enacted and ultimately doubled the then applicable federal exemptions of gift, estate, and GST tax from $5.49 million to $11.18 million. So it was a substantial increase in our exemptions. And this amount is actually adjusted annually for inflation. And as we all know, inflation has been chugging along the last couple of years. So in 2024, the lifetime gift and estate tax exemption is $13.61 million per person and is expected to increase in 2025 as well. So what this means in 2024 is that an individual can give away up to $13.61 million less any prior taxable gifts. So if it was a gift above and beyond the annual exclusion amount, for example, everyone knows you can give a certain amount each year. That's excluded from the gift tax. So if there was a larger gift, that would be considered a taxable gift. So everyone has this exemption, can give away up to $13.61 million, absent any existing taxable gifts that were given, or could pass that same amount upon their death free of the estate tax. So they are combined in a certain way. And a married couple has twice that amount. So, easy to do the math there. And under the current statute, these amounts are set to expire on December 31st of 2025. So what the current law says is that we will sunset to 2017 levels adjusted for inflation. So about one half of what the applicable estate and gift tax exemption amount will be at the end of 2025. So the expectation, conventional wisdom, is this number will be approximately $7 million per person or $14 million per married couple. So knowing that this change is pending, knowing the current makeup of our Congress, and if you've been under a rock, we do have an election coming up this year. So there's a lot of uncertainty, right? We know the law says we will sunset, but there could be some changes in between. But we know what these exemption amounts are this year and probably next year. So on behalf of all estate planning attorneys, I behoove you, if you are thinking or have clients who are thinking about doing any lifetime gifting, please contact your estate planning counsel sooner rather than later, just to at least get the ball rolling and start these conversations. So clients are considering how to leverage these current high exemption amounts during their lifetimes and shifting assets out of their taxable estate to ultimately reduce the amount of their estate that may be subject to estate taxes upon their death. And any assets that are shifted out of an individual's estate not only removes the value of that asset at the time of the transfer, but it also is a way to shelter or remove any future appreciation of an asset as well. So the gift out, and any further appreciation is not included in an individual's taxable estate. So it can be a very effective tool, particularly if we have clients who have assets that may likely appreciate in value or already have some assets that they're thinking they want to identify to give away. And gifts of assets really can be to anyone. So could be to family members, could be to an irrevocable trust for family members. Gifts can also be charitable in nature, which is why we are here, as well as or charitable gifts, I suppose, could look like direct gifts to a specific organization. I'm writing a check to this organization to be used for whatever purpose I deem appropriate. I could be establishing a donor advised fund or some other fund with an organization like the Charitable Foundation that's going to help me serve my philanthropic purpose and meet those goals. Or it could be establishing a charitable trust. So that's something that I'll talk a little bit more about. And charitable giving is a wonderful thing, right? It allows us to improve the nonprofits and charitable organizations that we feel strongly about. And it's also an effective way to reduce our overall estate subject to federal estate taxes. So it's definitely a useful tool and does achieve a couple of different goals. One, charitable giving, and two, the tax savings that might result as a result of this type of giving. So there are a number of options for clients to consider to achieve their goals, their charitable planning goals, and transfer of family wealth. And there can be some combinations of both of those things. And another thought when you're talking to clients, if clients have an asset that has a low basis, so they purchase stock or a piece of real estate years ago, it's just appreciated in value, and they're thinking about making a charitable gift, those types of assets can be very useful for charitable giving, because essentially it removes the value of the asset, the underlying asset, and it also pushes any gain to the charity or nonprofit organization as well, and that results in tax savings from capital gains. So it's often when we're talking to clients, that's something that we look at is the profile of their assets and determine whether any assets could be used for this type of giving, again, just to leverage that tax savings. So I will, and I'll go into charitable trust in just a minute, but I do caution. So this is a very high level. We don't have a ton of time to go over these details. So any clients or any discussions with clients who are thinking about charitable planning, certainly any trust planning that involves a charitable aspect, really should include not only the estate planning counsel, the advisor, and tax planning advisors as well. I always recommend including the organization's representative so that we can ensure that our clients' charitable goals will be met and are achievable. Sometimes we come up with fantastic ideas for charitable planning, but the organization itself either can't receive a certain asset or needs to go through their own internal processes to make sure that it's going to work for the organization. So having everybody at the table early on makes a lot of sense. And it also keeps the organization up to speed as to what might be coming down the pipeline for them as well. So as someone who sat on a number of boards, that can always be really helpful to know. So I will, so on our next slide here, we have some information about two kind of general types of charitable trusts. So there are a number of them, but these are really kind of the gold standard, if you will, and kind of good for this discussion. So the first is what we call a charitable lead trust, or a CLT. Estate planners love their alphabet soup. So this type of trust can be either established during lifetime or established upon a donor's death through their estate planning documents. And the idea really is that there is a contribution to this trust, and there is an immediate partial charitable income tax deduction. And essentially, while this trust exists, the trust makes payments to at least one qualified charitable organization named in the document on at least an annual basis for the term of the trust. And that term could be a set number of years. It could be based upon the lifetime of one or more named individuals. But nonetheless, the term of the trust has an end date. And once that term expires, the remaining balance of the trust will be passed over to one or more individuals. So the charity is really the lead beneficiary receiving distributions over time, and then non-charitable beneficiaries are going to receive the balance of that trust upon the trust termination. And the payments to the charity can be structured like an annuity. They could be essentially meaning the payment is determined as a set percentage of the value of the initial funding of the trust, or it could be more of what we call a unitrust type of arrangement, meaning it's a set percentage of the value of the trust redetermined on an annual basis. So there's two kind of options there with respect to the payments to the charity. And like I said, once the term ends, the trust terminates and the distribution goes out to non-charitable beneficiaries, which could be individuals, other family members, trusts for the benefit of other family members. So there are a lot of options there. And really the value of the contribution is determined to look to the charitable interest. So that is the present value of the stream of payments that will be made to the charitable organization over the term of the trust. And that amount is wholly deductible from gift or for as a charitable deduction for gift and estate tax purposes. And the value of the remainder interest, what will pass to the non-charitable beneficiaries, is wholly taxable for gift and estate tax purposes. So some of this is a numbers game, right? And figuring out what makes the most sense and where we want this income stream to go. And in our current environment where interest rates have increased over time, the value of the income stream to the charity actually decreases, and the value of the taxable remainder interest will increase. So these types of trusts tend to be more popular and attractive in low interest rate environments. That said, we look to the applicable federal rate that's published by the IRS every year, and that is certainly lower than typical commercial rates that we think about when we think of interest rates. But as the rates have increased, sometimes these don't really make as much sense as they used to. And as an important note, and I know I said I wasn't going to talk about GST taxes at all, but just to keep in mind that even though we're talking about estate and gift planning, depending on who our non-charitable remainder beneficiaries are, that might actually trigger some generation skipping transfer taxes upon termination. So just to be aware, that could be an issue. And again, working with qualified advisors to identify what those potential issues might be is going to be very valuable for everyone. So the opposite or inverse of the charitable lead trust is what we call a charitable remainder trust. So basically, it is, again, established during lifetime or at death. And someone, a contribution is made to this charitable remainder trust. And while the charitable remainder trust exists, the trust pays an income stream, just like the charitable lead trust. But instead of being paid to a charitable organization, the income stream is paid to a non-charitable person, individual. Could be the donor, it could be donor's family, it could be some other individual. And there are certain term limits as well. And depending on the structure of the charitable remainder trust. So keeping that in mind. But this can be a very valuable tool for clients who want to provide some sort of income stream to their family members, perhaps children or grandchildren. And then at a certain termination date, be it a term of years or upon the death of a named individual, the balance of the trust passes directly to the named organization or organizations that are qualified charitable beneficiaries. So and these income streams can be just like the charitable lead trust, either more of an annuity type of stream that is determined at the beginning, a percentage of the value of the contribution to the trust, or could be more like a unitrust type of arrangement. That's a set percentage that is paid based upon the value of the trust each year. And upon termination, the remaining trust property will pass to charitable organization or organizations. And there are some rules with respect to these charitable remainder trusts. So the remaining passing to a charitable organization must be at least 10% of the initial fair market value of the contribution to the charitable remainder trust. So again, some of these IRS rules get very nuanced, and we always want to be sure that we're keeping in mind all of these when we're drafting these types of trust. So the contribution to this remainder trust will qualify for a partial charitable deduction, limited to the present value of the charitable organization's remainder interest. So we look in the future and determine what's the value of that remainder interest. And that is calculated as the value of the donated property, less the present value of the payments that are going out to an individual. So again, there's some calculations involved, and it's always good to work through the numbers to make sure that this will still work for clients. And the benefit to a charitable remainder trust is that the full value of the trust, including any future appreciation, as we had talked about before, will remain outside of the donor's taxable estate. So again, a wonderful way to transfer wealth to a family member or family members, but also fulfill those philanthropic goals as well, while resulting in some estate tax savings as well at the federal level. So those are just two options, but that gives you a little bit to consider or work with and have these discussions. So on our next slide, we have a discussion about charitable funds, and these are fantastic options as well. So a charitable fund, like a donor advised fund, which probably many of the financial advisors on the call are familiar with. There's certainly an option at New Hampshire Charitable Foundation as well. But these funds can receive a gift from donors during their lifetimes or upon their death. So again, via their estate planning documents. And any assets contributed to a donor advised fund during lifetime or upon death are deductible, and that value is removed from the donor's taxable estate. So again, a nice way to achieve those goals and result in some estate tax savings. And these types of funds are also fantastic options for legacy planning and for involving family members in the next generation, to enjoy and participate and understand a family's philanthropic goals and plans. So a donor advised fund, for example, will name the donor and other individuals who can recommend grants from the fund to qualified charitable organizations. And one generation may find certain organizations are very important to them. And then when we move down to the next generation, perhaps that next generation just has a very different feeling about what organization should be receiving grants from these types of funds. So it's a nice flexible tool, but it is a very valuable tool to include multiple generations in the family philanthropic plan as well. It operates like a family foundation in a way, if you're familiar with that concept, without the administrative burden. So it allows clients to really take advantage of charitable giving, philanthropic legacy planning without all of the reporting and administrative burdens that come along with a family foundation. So the organization sponsoring the DAF can handle all of that for the benefit of the family. So I know that was kind of a quick overview, and I thank everyone for their time. And I know Peter is ready to expand upon expected changes and planning opportunities for federal income taxes. So I'll turn it over to him.
Thank you, Jen. Always great to collaborate with you and your team. See a lot of familiar names. It's nice to see everybody again. So currently, the standard deduction is pretty significant. 14,600 for an individual and 29,200 for a married couple, so both under 65. So the income tax rates will go back to the old regime. Most brackets will be increasing, and the highest tax rate will go up to 39.6%. Deduction for charitable gifts is going to be reduced. It's right now 60% of your adjusted gross income, and that will be going down to 50%. So what can we expect in 2026? So the standard deduction is going to be reduced almost by half. Currently, most people do not itemize their deductions, and that's mainly because of the $10,000 SALT state and local tax deduction limit, and also historic low mortgage interest rates. So that has made it difficult for taxpayers to get a tax benefit for charitable giving. So as the standard deduction increases every year, the SALT cap, it remains the same, and your mortgage interest deduction keeps reducing. So that spread makes it more difficult. So the spread for the standard deduction increasing makes it more difficult for the taxpayer to receive any sort of charitable benefit. So in 2026, this SALT limitation will be removed. The mortgage interest limitation is going to be increased. So right now it's 750,000 of principal. It's going to go up to $1 million, back to $1 million, plus $100,000 line of credit. And so this means that, and also miscellaneous itemized deductions is coming back. So we used to have a 2% AGI limitation on investment fees, unreimbursed business expenses, tax prep fees. So that will be reintroduced again. So that means more people will be able to get a tax benefit from these charitable deductions. So right now in 2024, a married couple under 65, they would need to give more than $19,200 to get $1 of charitable tax benefit. So we're gonna go to the next slide and talk about some opportunities. So as most of you know, the foundation has donor advised funds. So one big, strategy is to combine your charitable donations in once to get a larger charitable deduction. So there's a number of reasons this benefits the taxpayer. It helps organize their charitable giving. It can make it easier by streamlining how they make the distribution checks. So you make the request for the distributions and you get all the checks at once. And it simplifies their record keeping. They just have to keep track of one donation versus multiple receipts. And as Jen mentioned previously, one of the big benefits is you can donate appreciated property. So this is a double benefit. You avoid capital gains tax and you get the fair market value of the donation. One big benefit of the foundation is a lot of us are familiar that you can give public stock, publicly traded stock very easily. The foundation will actually take other property besides publicly traded stock. And you can reach out to Mike and he can get into more details about that. There's a little more due diligence, but it is possible. So these other items are more planning opportunities that may come up with charitable giving. So for example, you have a client that made a pledge for multiple years of large donations. Well, now they have this large charitable deduction, but do they have enough income to take advantage of it? All right, they've kind of locked in what they're going to do for the charity, but now let's get them some sort of benefit from it. If they're in low income bracket, because of the deduction, you may want to generate some income by doing a Roth conversion. Other items is accelerating other income. Given that 2024, 2025 are going to be lower tax rate years with 26 looming, you may have a client that may be selling a business. So, if it's possible, you want to make sure that it happens before the sunset of the rules. Another opportunity is to possibly delaying harvesting losses. Now, we have a saying that don't let the tax dog wag the tail. So we don't want to make decisions solely based on tax purposes, but under certain circumstances, you may have more control or be able to time taking losses to be more tax advantage. And I'm a huge proponent of donating appreciated property, but sometimes that's not the case. You may have to donate cash, right? So if you were to do that, you may want to consider doing it in either 2024 or 2025 to get a larger charitable deduction. So another item is for those who have reached 70.5 is to do something called a qualified charitable distribution. So what this allows the person to do is make a charitable donation directly from their IRA, and it goes to the charity, and they don't have to pick up that distribution as income. The old requirement was when RMDs were 70.5. That's why that age is significant. But when they increased the RMD age, they kept that age requirement for QCDs the same. So that's great that they did not increase it. And I see a lot of taxpayers that don't realize that this is available to them. As CPAs, if you see a client that's over 70.5, they make a donation that's could be significant. Usually anything over 1,000, I mention it to clients. It's enough to make a significant tax savings in their pocket. But once you see 70.5, some charitable donations, you can mention it to them, especially if they don't itemize. So that's what I have for now. Everybody's situation is different, so this is very high level. There's a lot of planning involved. I think that's when you are the most useful as the advisor to coordinate and help out your clients and figure out how they can give generously and be able to get some tax benefits at the same time.
Great. Thank you so much, Peter. And it is, something that I would personally say, right? We at the Charitable Foundation want to be here to help you and your clients consider these, right? We cannot always get into the intricacies of the laws around charitable trusts or, even giving tax advice as Peter would. But certainly considering what to give, right? What types of assets might be worth considering, and sort of the structure and timing of gifts, as well as, and I think often, really importantly, what to do with those gifts. So, okay, somebody decides for family reasons, for tax reasons, because we have a liquidity event, et cetera, we're going to make a large charitable gift this year. But what to do with that, how to actually make an impact in the community is a next and really important step. So I wanted to take just a quick second to highlight some of the ways that we at the Charitable Foundation work and the funds that we offer, and then we'll turn to some Q&A. So as Jen and Peter both mentioned, right, donor advised funds can be a really great tool around a lot of these planning opportunities, whether it's in current giving, right, lifetime giving, someone wants to establish a donor advised fund so that they're only tracking one deduction that they need to, have that receipt when they do itemize. Or if they're bunching multiple years of giving together to capture a larger deduction this year, and then having smaller deductions, or maybe even using the standard deduction in future years. Or if it's using a DAF to create a legacy and really engage and involve their family. So Jen and Peter did a really amazing job capturing some of the benefits of that. At the foundation, we also offer a variety of other fund types. One is scholarship funds, right? Education is something that we hear from a lot of donors as being important to them in a way that they want to focus their giving. So we actually administer the largest source of publicly available scholarship in New Hampshire, make about $8 million a year in scholarship awards. And folks can set up a fund with their given interests and purpose. We have flexible funds and field of interest funds. I'll group them together for sort of sake of ease of description, where charitable foundation staff will take the guiding language of a donor or of a family and make grants accordingly. So flexible fund is going to be pretty wide open, right, to support nonprofits in New Hampshire. Field of interest fund is going to narrow that to say, support nonprofits who are focused on, eliminating food insecurity and encouraging the arts, or right, whatever somebody's personal interests are, they can give us those fields of interest and we make grants accordingly. Or even if a donor has an interest in a specific nonprofit, but for whatever reason, whether they want to make a large non-cash gift, and we at the foundation have the ability to, accept that, do the due diligence and accept that gift, and a small nonprofit may not. Or if somebody wants to sort of set up a pseudo endowment for an organization, a designated fund allows a donor to designate a specific recipient nonprofit, and then we can make grants out to them either at a sort of endowed percentage and make an annual grant in perpetuity, or on a set spending schedule. Agency fund is very similar to that, but instead of a donor creating it to benefit a nonprofit, actually a nonprofit is creating a fund with the foundation for their own sort of benefit. That one, an agency fund, doesn't have the same relevance to today's discussion on tax law changes, but certainly an option. So, all of the strategies that Jen and Peter just discussed, whether it's creating a charitable trust that is going to pay out to a nonprofit, right, at some point, that can be channeled through the Charitable Foundation to really achieve the specific charitable goals of the donor, or making lifetime gifts, again, channeling it through the foundation to achieve those goals in any of these fund types. That's largely what we had today to share with you in terms of presentation, but do have some time and certainly welcome your participation, your questions, questions about the specific strategies we discussed, your insights on things that you're hearing from your clients or situations that have come up or creative solutions you've seen, and are always happy to engage in those conversations. Please share questions today if you have them, or if there's more nuance or more specifics and you want to dive into it offline. We are always here, right? My role at the foundation is being able to be a sounding board and be a resource about charitable planning. So look forward to hearing from you.